You're listening to another episode of the Young Investors Podcast, so sit back and relax as myself, Brandon, and my buddy Hamish discuss the latest in the world of finance and stock market investing. Now, a quick reminder before we get into the podcast is that nothing in this podcast should be taken on as personal financial advice. If you're ever unsure about your finances or investing and you need some help, make sure you reach out to a qualified financial advisor. But with all that said, let's get into another episode of the Young Investors Podcast. Welcome back, everyone. Welcome back, Hamish. How you doing, mate?
I'm doing well. How are you doing, Brandon?
Doing well. Yeah, I'm doing quite well. I bought something this week.
Oh, did you? I bought something too, so we can.
Oh, really?
We could share.
Oh, there you go.
How funny would it be if we bought the same thing? Because it's possible.
I highly doubt it. It would be insane if we did.
Oh, okay. All right.
It would be. All right. What did you buy?
No. You go first.
I'll go first. Well, I'm making a video. It's for a video that I'm making. I bought the highest denomination banknote that has ever existed in the whole world.
Oh, where's that
How
from?
interesting is that?
Wow.
Can you guess how what the number is on this banknote?
I don't know. Really high, like something outrageous.
It is really outrageous.
So, like,
it is a country that experienced
a lot of inflation.
Hyperinflation. I'll tell you,
Okay.
it's Zimbabwe.
Right. Okay. Is it trillion? Is it a trillion or something ridiculous?
It is $100 trillion.
Wow.
The $100 trillion banknote.
And do you know how much that equates?
I know exactly how much it's worth. Guess how much it's worth in US dollars. Well, you could trade it in up to 2016. You can't trade it in anymore.
Right.
But in 2016, April 2016, guess how much 100 trillion Zimbabwean dollars was worth?
I have no idea. No idea.
It was worth 40 US cents.
Oh my God. That's not good.
How crazy is that?
Wow.
So I'm making a video about it. So that should be coming out on the channel hopefully next week. But it's very interesting learning about that hyperinflation in Zimbabwe with under the rule of Robert Mugabe and what happened there. So yeah, it was very interesting. Anyway, what did you buy?
Yeah,
sir?
so I didn't buy that. I bought a new light. It'd be funny.
Oh, you got a new light?
Yeah, I did. So I bought a what is it called? Aperture 120D.
Mark II?
What is it?
Was it the 120D Mark II?
Yes, Mark II. Yeah. So it hasn't come yet. They were back ordered a little bit. So I don't know when they're going to ship it out, but that's what I ordered this week. And I thought that maybe when you said you'd ordered something, it could have been the same because we did talk about that.
We've been speaking about it, haven't we? Yeah. Did you get the Light Dome 2 or the Light Dome Mini?
Light Dome 2. Yeah.
Nice. I hope you got apparently it's quite big.
Yeah, so I think I should have enough space for it. But
yeah, you'd have enough space, but apparently it's surprisingly large, that light dome.
Yeah,
but hey,
it's
I mean,
huge.
It's got to be big. It's got a lot of diffusion. It's a nice light.
Yeah.
I can't wait to see what it looks like in your videos.
Yeah, me too. They haven't even sent it out yet because they were back ordered. So I'm expecting it probably in maybe 2 or 3 weeks or something. So
right, okay.
Yeah, when that happens, I'll let you know, and then you'll probably see a dramatic improvement or some sort of improvement, hopefully in the quality of my videos.
Fingers crossed.
Yeah.
Oh dear. All right, well, what are we talking about today? What do we got in this podcast? What have you got to talk about today?
Yeah, we've got a couple of things. One thing around Google and their Play Store. They've been making some changes that are going to impact app developers. An acquisition that Corporate Travel made, one of the companies that I'm invested in. So those are the 2 big stories that I've got.
Nice. I've got, I think we should talk about the presidential debate a little bit.
Yeah, definitely.
But I've also got some stuff. Apparently Johnson & Johnson's doing some interesting things with their coronavirus vaccine. And I got an interesting story about a Chinese teapot, which is kind of out there, bit left field. But yeah, I guess we'll cross that bridge when we get to it. Yeah. All right, let's get stuck into it.
Yeah, so today's episode is sponsored by Sharesight. And Sharesight is an application that you can use to track the performance of your stock portfolio. And it's really good for keeping track of your capital gains, dividends. If you have dividend reinvestment plans, then it will do all of those calculations for you. Currency gains, if you're buying shares internationally or you hold foreign currencies. And then the main reason why I use it is when it comes to tax time. So Sharesight generates up to 10 different reports that can be used at tax time to easily work out things such as your capital gains, dividend income, and more. And at the moment, you can try Sharesight for free by heading over to sharesight.com/young investors. That's site spelled SIGHT. Sharesight.com/young investors. So you can try it for free using that link. But also, if you want to sign up to a yearly subscription, you can get 4 months free when you sign up to an annual subscription. So go check that out if you're interested. And just in relation to, well, not really in relation to that, but we had a follow-up from one of the Q&As that we had last week. So one of the comments left on this podcast was, hey, Hamish, you mentioned you buy US dollars. I was just wondering where you buy them from. So I can't actually remember what we were discussing, but something about currency exchange.
Yeah, probably exchanges. Yeah.
But yeah, I thought I'd give a follow-up to this question straight away. So I just buy US dollars from CommSec International. So CommSec being the broker that I use for Australian and international trading. And if you have an international account, you can deposit money from Australian dollars into US and other currencies, depending on which market you're investing in. So that's the way I do it. So yeah, I thought I'd just give a follow-up there. And yeah.
Well, and I do it through Stake. So there you go.
Yeah, perfect.
All right. What should we talk about first? You want to talk about Google?
Yeah, all right. Let's talk about Google. Yeah, so the headline this week from Google was that they're closing one of their Play Store loopholes. So
okay.
This story's got it's a little bit confusing. So I'll take my time kind of going through, and hopefully it's not overly
get the popcorn, everyone.
Yeah, exactly. Sit back and relax, and let's talk about some loopholes.
All right, hang on. I'm gonna. You remember me talking about my fancy new chair?
Yeah.
I'm setting it to its maximum recline. Yeah. I'm gonna pull my microphone in, and all right, I'm ready to go. I'm ready.
Fantastic. Yeah. So I think most people know Google Play Store is an application store that you can get on Android devices. It's the native app store. And currently, app developers pay a 30% commission to Google for all in-app purchases. So that's pretty standard. Apple has the exact same 30% commission on in-app purchases. So any purchases made, obviously, within the app.
Right. Okay.
Yeah. But up until this point, Google has also allowed apps to just have their own payment system inside the app. So one of those examples is Netflix, for example. If you had the Netflix app on Android, you didn't necessarily have to use Google's in-app purchasing. You could have just entered your credit card details in the app, and Netflix would be getting 100% of that rather than 70%.
Right. Okay. Yeah.
Yeah. So, so that's the loophole that Google's going to be closing now. So before, you could, in Netflix, for example, you could be entering your credit card directly into the app. But now, if you try to sign up to Netflix through the app, you'll be going through Google's billing system, which will then give Google a 30% commission. And I mean, this isn't as big of a deal as it sounds, because Google said that this only applies to 0.09% of their apps. So a very small number of their apps have this kind of setup like a Netflix. I think Spotify also has it, where you can just pay directly.
Yeah. Although I was going to say 0.09% can probably, even though it's 0.09% of apps, it can probably, like you're saying, include a lot of high up there apps.
Exactly. I mean, you would imagine for something like a Netflix or a Spotify, there's a lot of money that Google would be gaining by closing this loophole. Yeah. So, I mean, I guess it's not as big of a deal because it's a small number of apps, and also consumers. I mean, you can still go to the Netflix site, for example, and just sign up directly. So it's possible that if you sign up during the app, it's in the app, it's going to be maybe 30% more expensive now, or a little bit more expensive than it was before. But you can always just go directly to the website. So it's not that big of a deal. But the reason why I kind of wanted to discuss this is because there is a lot of debate going on around app stores at the moment, and particularly around Apple and Google having too much power against app developers. So we know that Apple's in a battle. Who are they in a battle with? Epic Games, I think.
Don't know, maybe,
at the
yeah.
moment. Yeah, so they're in a lawsuit, I think, where basically Epic Games, which owns Fortnite, they decided to allow create a system in their app that bypassed Apple's in-app purchase system to bypass that 30% fee, and Apple just banned them from the app straight out. So, yeah, I mean, and fair enough. I mean, they broke their terms and conditions, but now Epic Games is suing Apple to say that it's I don't know what they're saying, that it's anti-competitive to not allow them to have their own system. But
yeah,
I wanted to just draw a little bit of a comparison between Google's App Store and that situation with their 30% commission and Apple's situation, because the way that the two have gone about it is quite different. And I'm curious to hear your thoughts on this too. So to me, Google has a much more appealing approach. So they have that 30% commission, same as Apple. So if you do in-app purchases through the Google or Apple payment system, you pay a 30%. The app developer pays a 30% commission on all their sales. But in Google's situation, you can download other app stores. You don't have to have the Google App Store on your Android device, or you could just go and download games directly from any website, right? There's no restrictions on what games you can download. It's not just what's in the App Store. And Google also said that it's perfectly okay for an app to direct people to their site to avoid the fee. So it's okay for Netflix to say, hey, you're going to pay more for this subscription if you buy it in-app. Go over to our website and you'll get it for cheaper. That Google's that's completely fine. And that's very different to Apple's approach, where Apple's App Store is the only option. You can't download any other app store. And you also can't download any apps outside of the App Store. And even further than that, Apple doesn't even want you to know that they're charging a fee, because there was a really funny thing that came out from Facebook recently, where I think Facebook did this just to have a little bit of a dig at Apple. But they tried to add a line. So in Facebook at the moment, you can do in-app purchases to buy things on Facebook Marketplace, for example.
Yeah.
And they added a line below the pay button that just said, Apple is collecting a 30% commission. Facebook collects zero. Because they just wanted to let people know, like, Facebook doesn't take anything on their marketplace sales, but Apple is taking 30%.
That's crazy.
And Apple,
it's a little jab, isn't it?
Yeah, like I think it was a little bit of a cheeky jab. And Apple actually blocked the update. They didn't allow them to do that, even though it's even though it's the truth, even though that's the situation that's happening, right?
Sneaky Apple.
So yeah, I mean it's a bit of a non-story, I think, in terms of the actual loophole that's being closed, but I think it poses an interesting conversation around whether Apple should be allowed to have the setup that they do, where if you're an app developer and you want to get in front of Apple iPhone users, you have to pay that 30% commission. You have no choice. Whereas on Android, it's a very different situation. What do you think about this? Do you have any thoughts around this?
Yeah, it definitely raises an interesting discussion. What you're saying before is that whether it's from Apple's perspective or Google's perspective, I mean, they'd be standing up and saying, well, hang on, we've built these big businesses. We've come from the ground up. We've built a system where everyone buys iPhones. We've created this monopoly through private enterprise, and come on, we deserve to be able to, take financial advantage of the moat that we have created for ourselves, because that's just clever business. But again, there's the other side of the equation where we get to companies that are so large where we start saying, well, hang on, they have such a monopoly, or they have such an advantage where they are now, where they've built themselves up to, that is it actually fair that they're allowed to do whatever they want with their platform? It's like what we're talking about with Google, with their Google search, or Facebook, or lots of these other big tech companies. Is it fair that they're able to just do whatever they want on their own platforms, considering like in Facebook's case, I think it's around about a third of the population of the earth uses Facebook at least once a month. I mean, when you search on the internet, you're basically always Google searching. So is it fair for them to be able to just put their own business interests first, and just exploit the massive moat and the massive amount of power that they've built up through their business over time. And that's where, that's why, anti-competitive law is, so murky. And, what is it? Google's copping billions of dollars worth of fines every year as a non-recurring expense because they breach some sort of antitrust law or something like that. Yeah. But you're right. It's a big debate. And while what you're saying here is a bit of a non-story, it's just like Google's just closing a loophole and collecting their commissions for 0.09% more apps. It definitely does raise that bigger debate. I'm interested. Where do you kind of stand? On this?
I mean, I think I tend to lean more on the side that I would allow Apple to have whatever restrictions they want for their own product, right? Because they've built their reputation on having a really secure app store. And I mean, there's no doubt about it that, if you have an Android device, it's a lot safer when you're downloading apps to be downloading them from the Apple App Store. It's relatively safe on the Google Play Store, but then you also have the option to download apps from any website, which could be severely harmful to your device. It's kind of like Apple is the gatekeeper of that, whereas Google says, if you want to take your own risk and download from a random website, you can.
True. Yeah.
So, I mean, and the other thing to mention, I think, is that, iPhones at this point, I think I saw the market share. I think it was maybe 15% of all phones, smartphones sold, or maybe 20%. So it's not like they have some monopoly on users, smartphone users. So app developers do have a choice there. They can go to Android devices, which make up the vast majority of devices. And then they can use some of Google's little bit more flexibility to bypass that 30% commission if they want. But yeah, I think I kind of lean on the side that Apple, with their own physical product and their own digital products, they should be able to do what they want, particularly, I think, from the security standpoint. Because there definitely is value in having an app store where you don't have to be very switched on to which apps are safe and which ones are not. You just know that, if you're accessing the Apple App Store, it's going to be an app that's safe. That's kind of that's a big deal, I think, for a lot of people. Whether it's 30%, whether the app developers agree because of that 30% haircut, I don't know. But yeah, that's probably where
it's a good way to put it. Nah, I tend to agree with you. I tend to lean on the side of businesses have built themselves up to a point, therefore they kind of deserve to be able to, reap the profit, reap the rewards of their business endeavors over time.
Yeah.
But yeah, there's obviously it's a fine line, because there's a point where if you let it go too far, then select companies do have too much power, and then if they abuse that power, it can be very manipulative. So.
Yeah, I think it would be a different story if iPhones made up, 95 out of 100 phones that were purchased, right? So Apple really did have a monopoly on people, accessing apps, right? Basically, then that's a different story. I think, but yeah, it's kind of like exactly, because then they could just set the rules, they could do what they wanted, and no one could really do anything about it. So yeah,
they would have a lot of power there. All right, shall we move on to something different?
Yeah. Let's talk about one of your stories. What have we got?
Sure. Well, I can talk about Johnson & Johnson. This is actually news that we didn't get to last week because we're talking for so long about Tesla. But Johnson & Johnson have now also begun their stage 3 coronavirus vaccine trial. So it says here that J&J have begun dosing up to 60,000 volunteers in a study of its COVID-19 vaccine, marking the first big US trial of an inoculation that may work after just one shot. That's kind of the point of difference with Johnson & Johnson. Did we talk about this last week? I can't remember.
No, I'm pretty sure we didn't talk about this.
Maybe it's just been sitting there and I've read it through a couple of times, but just reading that, I'm like, hang on, have we covered this news story before?
Did. That'd be funny if we did.
Well, guess what? We're covering it again. Maybe we did. Now I'm really just doubting myself. Anyway,
give us the headlines of it anyway.
We're covering it again. because I was doing a little bit more reading about it today anyway. So interestingly, they are now that they're the fourth vaccine maker to move its candidate into large stage human studies in the US. If enrollment goes as expected, the trial could yield results as soon as the year end. But this is actually that's promising, but they're actually a little bit behind because I think that what was it, Moderna and Pfizer, they've got studies that should be ending or getting results by the end of October.
Wow.
However, the two that the Moderna one and the Pfizer one are 2-dose vaccines, which obviously wouldn't be as good as if you could just walk in, have one jab, and that's all. Because 2 shots, you have to come back for a second dose and blah blah blah. But anyway. But yeah, I think that's very interesting. I mean, these companies have really gotten a move on, but I'm going to find it interesting. I'll be very interested to see, because usually there's a period of time, as I understand it, like a year or two, where they kind of watch if there's any side effects or if anything's happened to anyone that took part in the stage 3 test. Yeah. But it sounds like they, in this case, because the coronavirus is such a big thing, they might actually be able to get approval before that kind of stage, which is interesting.
Yeah, it's kind of strange, right? Because on one hand, you want them to do the tests, the late stage testing on humans very carefully, and you would imagine that you would have to. I mean, for any of these tests, I don't know how vaccines work or anything like that, but I would imagine that there could be the potential that there are side effects, a year after or 2 years after the person takes the vaccine. I would imagine that not all of the side effects would have to take place in the first few months, but maybe that's an ignorant point of view. So
I don't claim to be a scientist either, but I mean, there's always a potential.
Yeah, so it is strange because they're clearly, I think, obviously everyone's very keen for them to rush through some kind of vaccine so that, we can get back to some kind of normal, but yeah.
This is just another interesting case of, it's kind of like there's two sides of the coin. There's two kind of tails, and it's like a trade-off. It's like how quickly do you rush doing the vaccine? Because the sooner we have a vaccine that looks promising, we can give it to a lot of people. We can start opening back up, travel, business, mental health, all these things might see an improvement. But at the same time, there's definitely reasons why you want to see long-term, effects after a trial. So it's just one of those interesting things where it's like, how are they going to go about getting this vaccine out there? How many steps or how many tick boxes are they going to just not worry about in order to try and get it out there? But look, I'm sure that they would not release a vaccine unless it was pretty much perfectly safe.
Yeah.
It's an interesting case where it's like it's a bit of a trade-off. Just because of the severity of the thing that they're trying to treat. So
yeah, exactly. Fascinating that a couple of companies will have their results near the end of October, which is
it's soon,
a lot
isn't it?
Sooner than I was expecting. That's fascinating. I guess at that point we'll find out whether or not they've passed. I think Bill Gates was suggesting that it's in most cases they will still fail a stage 3. So it's in the best case, you have a number of running options, which there's now 4 in the third stage. So I guess we'll kind of see what happens, see which ones fail, which ones succeed. And then I imagine it takes quite a while to manufacture the vaccines, even after they pass that third stage. So
they got to make a lot of doses, don't they?
Especially if it's 2 doses per person.
So. If it's 2 doses per person, then I guess, I mean, if you want the whole world, if you want everyone on this here planet Earth or thereabouts to have this coronavirus vaccine, then you're going to need quite a few doses.
Yeah.
I don't think that production line will be slowing down for many years to come.
Very interesting.
Anyway, that's kind of all I had to say about the coronavirus vaccine. Just an update that J&J are doing their third stage trial.
Yeah.
All right. What should we get into next?
All right, we could briefly talk about this corporate travel management acquisition. It's not a huge Australian company, but it's in my portfolio, so I've been watching it quite closely. And I know that there's a number of listeners of the Young Investors podcast that have spoken about corporate travel before. So this might be an interesting sort of story to cover. But so this week on Monday, they announced that they're acquiring a US travel company, T&T Group, Travel and Transport Group.
Oh, okay.
Very plain names. Corporate travel management and then travel and transport. It's not like it's got any kind of, it's not a Google, is it? It's not a Netflix.
That's no, exactly right. But that's like Peter Lynch. He says that he loves the stocks that sound boring.
Yeah, exactly right. And so they announced on Monday they're acquiring this US company. Both are corporate travel agencies. If you're wondering. So this North American company is based in Omaha, which is where Warren Buffett lives.
Warren Buffett.
Yeah. Speaking of boring, it's the home of boring, right?
Yeah.
I don't know. Isn't that what Warren Buffett says? He likes being as far away as possible.
Far away from Wall Street.
Yeah.
It's in the middle of nowhere. Nothing ever happens.
Exactly right. Yeah. So, I mean, just some of the headlines out of this acquisition. They have most of their offices on the East Coast of the US, particularly in New York, which is going to be very complementary to Corporate Travel's business, which has quite a few offices, quite spread out over the US, but quite a few on the West Coast. The company did $4 billion in total transaction value in 2019, which will add about 60% to Corporate Travel Management's business. So it's not some small acquisition where it adds,
That's a big acquisition.
Yeah, they're not adding 10%, they're not adding 20. Like it's a big sizable increase in their total transaction value, their revenues, and then also their profits as well.
Yeah.
And I thought, I mean, in terms of the deal itself, the company had EBITDA, so basically earnings before tax and depreciation, of $39 million in 2019. And then interestingly, management thinks that after they sort of combine the two businesses, they'll be able to get an additional $25 million per year out of this company.
Okay.
So theoretically, if management is accurate, after everything is fully integrated, the cost to acquire this business would be about 4.3 times last year's profits. So pretty good valuation.
Geez, that's not bad.
Yeah. So and I mean, in terms of how they're doing the deal, so that they're paying $275 million for the company, and they're not using cash, they're not using debt. They actually opted to raise equity. So I know if anyone's sort of curious about learning about raising capital and share buybacks and all of that and how that impacts you as a shareholder, check out Brandon's video with who did you do it with?
Oh, with Richard.
Richard
Coffin.
from the Plain Bagel. That was fantastic, that video.
That was really good. He's such a knowledgeable guy. Yeah.
Yeah. No, it's fascinating because, I mean, most of the time I think whenever I see equity raise, I kind of cringe or I kind of think, oh, it's a negative thing. But certainly you have to think about like what they're spending the money on. And in this case, they're making an acquisition. So, I mean, obviously as a shareholder, if you're getting diluted, I'm getting diluted. I'm getting a smaller piece of the pie in exchange of getting a piece of this new business, basically. So that's kind of the question I'm asking is, am I willing to have a little bit of a smaller percentage ownership in exchange for getting a piece of this new business? Do I think that it will deliver to me more than what I'm going to lose immediately? So yeah, it's an interesting situation. But I think the most fascinating thing to me is that most people and most companies in the travel industry are just scrambling at the moment to survive.
They really are.
Pretty much wherever you look in the travel industry, if you're looking at travel agents like a Flight Centre or Webjet, both of those companies have raised shares or taken on a substantial amount of debt. I think they've both done both of those things actually.
Well, we spoke about last week. One of them went bust as well. One of them went into administration.
Yeah,
didn't it?
I can't remember.
STA or whatever.
Yeah, STA. That's the one. Yes, they went into administration. Both, Flight Centre and Webjet they're just kind of struggling to stay afloat. And then in other areas of travel as well, like cruise liners in the US, they're all struggling. A lot of airlines are struggling. So it's kind of interesting to see that kind of happen at the same time as something like Corporate Travel Management, who's kind of going on the offensive, where they had no debt going into the pandemic. They had a decent amount of cash.
Handy.
And their business is corporate travel, which was not hit as anywhere near as hard as leisure travel, as tourism.
Yeah.
So it's kind of interesting to see those factors and how that impacts their business differently to a lot of other travel businesses. And I think the CEO said earlier in the year that everyone else seems to be in survival mode, whereas they were going on the offensive and looking for opportunities to grow. And I guess this is the first time that they've done this during the pandemic. And I think, the major lesson I see out of this, and obviously we don't know the outcome of this acquisition yet or anything like that, but typically in when there's weak economic conditions, like what we're seeing right now, there will be many poorly positioned businesses that have too much debt or they expanded too quickly. And a lot of those businesses will either fail or they'll get close to failing and they'll dilute shareholders completely out, like a Virgin, for example, which, I guess you could say Virgin failed. They pretty much did.
Yeah.
Right.
Well, it did. Yeah.
But there will be other businesses that get near failing. And then there will be the businesses that are strong businesses that can acquire the struggling businesses or just take customers organically. The customers are going to shop somewhere. So if a poorly positioned business fails, those customers will go somewhere else. And they'll go to the businesses that are still providing really good service and well positioned to continue on.
And I'll tell you what, I remember, I think this was even when I was down in Melbourne, like the week before things really escalated and lockdowns started happening. And I remember we were making a video together and I think we were talking about what specific things do you need to watch out for in businesses, right now heading into what we were heading into at the time. And what we were saying at the time is you want to make sure that they have hopefully little or no debt or they're well in control of their debt, and you want them to have a nice cushion of cash. And, if the company can do both of those things, then it's much more likely to get through relatively unscathed. And this is exactly what we're seeing in this case, except this has actually helped out corporate travel in another sense, is that while everyone else is failing and while, when businesses are now, especially in the travel industry, are valued at much, much, much less than what they were, 11, 12 months ago, then corporate travel being in its position that it's in, having no debt. Did you say no debt?
Yeah. Well, they had no debt. They still have no debt actually, because they didn't
still have no debt.
They didn't take on any debt.
And having healthy cash, that enables them to be able to swoop. As opposed, like if corporate travel had a whole bunch of debt and, they didn't have a good cash pile, then they would be in the same boat as everybody else. They would be struggling. They wouldn't be thinking about being on the offensive, which is going to help them come out of, in 10 years' time, be a much stronger business. They would just be scrambling to survive. Whereas now they actually can. They can look, okay, this makes sense. This company has been shot. We can pick it up, relatively cheaply. It'll bolster our business. As you were saying, it's adding 60% to their, what was it, total transaction volume. So, this is just the difference. If you set yourself up, if you set your business up well, and, clever financial management, balance sheet management, robust, can handle any economic condition kind of balance sheet, then when things like this happen, these companies can pounce and they can make some really good deals that are going to make them much, much, much more valuable in 5-10 years' time.
Yeah.
So good job, corporate travel management.
Yeah. So, it'll be interesting to kind of see what happens and what the outcome of this is, because obviously we just heard about it. So we don't know. I really don't know that much about the company that they're acquiring. We've got a little bit of information, but until we see them kind of integrated, we won't really know what the impact is going to be. But certainly a little bit of exciting news for me. Recently, there hasn't been.
For sure.
There's really never a lot going on when you're a long-term investor. So something like this is exciting. Something to kind of research and look into.
Very good, very good. No, it's an interesting kind of case study, and it highlights an important topic which we just covered. So, all right, shall we move on to? We better talk about it. The presidential debate.
Oh no!
Here we go. So. Trump v. Biden yesterday. Wow. Interesting.
Yeah.
And I think we should go. We're not trying to get super political, so we're not trying to persuade you to vote for Donald Trump or for Joe Biden or anything like that. I think we'll just kind of comment on what we thought of the debate itself, and then move on. And you watched the whole thing, so I haven't watched the whole thing yet. I've just been able to catch a couple of highlights, a couple of news stories, but from what I've seen, it sounded like it was really bad. It sounded like the moderator needed a mute button so that when one person was talking, the other person, we could not hear the other person.
Yeah.
And then they needed to flip it over. I feel like that's how they should do debates.
Yeah.
It should be like, okay, Trump, you have 3 minutes. The topic we're talking about is this. And then they mute Biden. And then 3 minutes later, or however long it is, it flips over. So Trump gets muted and then Biden gets a chance to respond. I feel like that's the only way, because it sounded to me from all that I was looking at, mind you, I only saw highlights, is that they were just constantly talking over each other.
Yeah, pretty much. Yeah, I think some of the debates do have a thing where they mute the microphones. I think it makes sense to do that because there was a lot of interrupting. But I mean, both of them were interrupting. But Trump, he doesn't let anyone get a word in. So
he yaps, doesn't he?
Yeah.
Yaps and yaps and yaps. I found it funny when Joe Biden was just like, "Man, will you please shut up?"
Yeah, that was great.
That made me laugh. That was pretty funny.
Yeah, it was. I mean, from someone who's not that impacted by it, it's kind of funny, but it's also kind of sad that that's the two candidates.
you have to laugh, because if you didn't laugh, you would cry.
Yeah, exactly. No, yeah, I mean, I don't know too much what to say about it, except that it was a little bit of a joke, and there was just a lot of insulting back and forth, and I don't know.
Yeah,
Trump was
that's basically what. That's the one thing I hate. I hate when, politicians, the people that, in this case, the person that is going to lead the government of the United States of America, whenever the election is in November, you would have thought that this is a presidential debate. You would have thought that, you wouldn't expect name calling or talking about, Joe Biden's kids, or talking about, Trump's doing something else like, I don't know, white supremacists or something. You would have thought that the things that they would talk about might have been, economic policies or, economic plans and whatever, but nope. It's just nothing that helps anyone.
Yeah.
I mean, may as well. It's just like he said, she said for 2 hours.
Yeah.
Instead of talking about things that might actually impact the American people.
Yeah. I think the one thing I got out of this is, regardless of which sort of side you sit on policies, or whether you think that, what they were saying was the truth, Trump is a very good debater. There's no doubt about it that he's very clever. At least this is my like view of it. At least, he just doesn't let the other person say anything negative about him. And as soon as something negative comes up, he'll just be all over the top of them. And if if Biden would stumble with his words, or at one point he was like, "This is the first point," and then he said something, and then he was like, "And then the third point," and Trump's just chimes in and goes, "Biden, Joe, you're up to number 2." just like teasing or digging at him. I don't know. To me, like, in terms of the actual policies and getting across a point, like, I don't know, whatever. You can have your own opinions, but I think he's very good at kind of being in charge of the debate. I think is probably the right way.
He definitely tries to be the aggressor.
Exactly.
Doesn't he?
Yeah.
Tries to get on top of everything.
Yeah.
Yeah, there you go. One thing that was interesting was that I just saw this as a news article on Bloomberg. Apparently, of course, they would report this on Bloomberg, but apparently the debate worked surprisingly well for Joe Biden, who actually raised $10 million for his campaign yesterday.
Wow.
Which is pretty crazy.
Jeez.
Yeah. It said here that Biden had his best hour of fundraising in the campaign as the verbal slugfest was winding down, taking in $3.8 million between 10 and 11 p.m.
Wow.
Yeah. It's pretty insane. The campaign received more than 215,000 donations in the 3-hour period, said some official. There were 60,000 first-time donors. So there you go. It's pretty interesting that, just being on TV and everyone watching the debate, and all of a sudden you're just like, your campaign has just been absolutely cash boosted.
Yeah, I'd love to see Trump's numbers now to get a bit of, because I don't know if $10 million is like, I mean, I'm sure it's a lot for that time period, but I don't know how, much, I don't have anything to compare that to, right?
Yeah.
Like, I don't know if Trump during that did like 6 and then it's like, oh, well, Biden did more, but, both did a good chunk.
That's true, actually. Yeah. That's why I made the remark at the start that, of course, because it's on Bloomberg, of course, this is going to be about, the Democratic candidate, not the Republican.
Yeah.
But yeah, actually, I don't know. Anyway, so yeah, that's the presidential debate. Who are you voting for, Hamish? No, I'm just kidding.
Who am I voting for?
We're actually American, and
a lot of people think we are. Like, not that we're American, that we're Australian, but that we live in the United States.
We live in the United States, right? Well, I guess we do talk about a lot of American companies.
True.
But, I mean, we just talk about them because they're the ones we're interested in.
Yeah, I mean, everyone uses American products for the vast majority of what they use. So
yeah. Very
everyone's
true.
impacted.
Okay, well, let's talk about, what should we talk about next? Oh, let's talk about this Chinese teapot story. This is great. This is just a great story.
I was waiting for this.
Yeah, exactly right. The headline is Chinese teapot found in garage during lockdown sells for $850,000.
Wow.
How crazy is that?
That's crazy. That puts the little Yoda,
that baby Yoda thing
to shame.
Yeah, I know, right? That's crazy. This is just a feel-good story because it's just someone has just found something in their garage where it's just they've made a heap of money. All right, what does this say? A teapot, which almost went to a charity shop, sold for a whopping $850,000 at auction. The tiny yellow enameled vessel had been stuffed in a box for more than a decade and kept in a loft and then in a garage. But during the lockdown, its anonymous owner in the UK finally had a clear out and decided to get it valued. It turned out to be a 250-year-old Chinese wine ewer. Is that how you say that word? I've got no idea. Ewer. From the reign of Changlong Emperor from 1735 to 1796 and may have been handled by the ruler himself.
I love that bit.
Yeah, just add that in.
Been handled by him.
Allegedly.
It was allegedly used by him for 20 years.
Yeah, exactly.
Like, what?
Allegedly.
You don't know that.
Yeah. But they got to ham it up. This is a story.
Of course,
you got to make this as dramatic as possible. But apparently only 3 other teapots like this exist.
Wow.
There's 2 in Beijing and 1 in Taiwan. And then there's this one that someone just sold in the UK. But geez, man, it's just so lucky, isn't it?
Yeah, you get one of these stories every now and then where someone just...
Yeah, I wonder how many like millions of undiscovered dollars get, donated to charity or I'm not saying that's a bad thing, or sold at garage sales for like $1 or something. Yeah. I wonder how many of these quirky things that actually have huge value just get sold for peanuts.
Yeah.
It's probably once in a while you'd get something like that.
Yeah, and then eventually just landfilled, just chucked in the garbage.
Yeah,
just passed around from a few people who didn't get it valued and then thrown out. That would be something that I would do because I hate having I'm never going to be a person who has a lot of just stuff in storage. Like I throw stuff out.
Me neither.
I just throw it out. I just want the minimal required stuff.
Yeah, stuff. Yeah.
I hate having stuff pile up. So I'm never going to be a person who has something like this just stashed away somewhere. But there's a lot of people who just have stuff, like a lot of stuff.
Yeah. No, that's true. I'm not. I don't really. I used to collect Star Wars things, but they're just sitting at my parents' house. But yeah, just day to day, I've only got things that I actually kind of use. You do tend to gather junk, but I try to just not.
It's impossible not to. It's impossible not to gather some, but it feels good to.
But you just got to clear it out, don't you?
It feels good to clear stuff out, like your closet or something, just to get rid of all the stuff that you don't use.
Yeah. Intelligent Investor, chuck that out. Don't need that.
Chinese Teapot, keep that.
Yeah, keep that. Silver play button, chuck that out. Don't need that.
The child Ushi, keep that.
Yeah. Baby Yoda Ushi, get rid of that.
And the eBay pie.
No. Oh dear. All right, shall we move on to Q&A? Have we got anything else to talk about?
Yeah, we can just go. We'll just go into Q&A maybe. We've got a couple of Q&A.
I did have one more news story, but it's not really that exciting now that I actually read through it. Guess what, everyone? You know how Australia has been changing our banknotes to the new versions? Well, that's happening to the $100 note now as well. Whoopee. That's my last news story.
That was quick.
There we go. It's
speedy.
covered.
There really hasn't been that much. I mean, there's been bits and pieces going on, but there hasn't been that much. That's been really exciting for me, at least.
Yeah,
that acquisition was probably the most exciting thing that's happened in a while for me.
Yeah, I feel like I get nervous because I feel like there has been something big and I just haven't heard about it.
True.
So when I do these podcasts, I'm like, man, have I missed something big? I mean, I seem to have a whole lot of not crazily interesting stories. Have I missed something?
Yeah, I don't know. I don't read that much news like on a day-by-day basis, so could certainly
me neither.
Could certainly miss big stories. I'm just relying on Google News to send me a notification when something big happens. So
yeah, fingers crossed. So yeah, if you think there is a big news story that you would like us to cover, then definitely leave it as a comment so that we don't miss it. If you'd like us to talk about a particular news story. And while you're there, also, if you want to ask us a question, please do so.
Absolutely.
And we shall lead into the Q&A section now. We've only got 3 questions to get through today. Let's see if we can get through all 3. Yep. Okay, I'll ask this to you.
Okay.
I know you guys are both very interested in the stock market investing side of wealth creation, but I was wondering if either of you have plans to invest in property while you're in your 20s.
Yeah, definitely. Both of us.
Yeah,
I would say definitely.
Yeah.
I mean, it's probably something I would want to do over the next few years. It's not something I've thought about too much, like up until this point, but especially considering where the stock market is. If the stock market drops substantially, then I'll probably put a lot of money that I have on the sideline into the market. But if that doesn't happen, then I'm looking for some other kind of asset to put money into to deploy. So certainly properties. I mean, over the next 3 years, I think it's pretty likely that I'd probably invest in something.
Yeah. Would you buy like an investment property, or would you want to buy a home for yourself?
I would probably be living in it, I would say. Yeah.
I think personally, this is just my financial goal, is to try and get into a house and have it paid off as soon as possible. I kind of, obviously if the stock market crashed, I would invest heavily in the stock market instead, try and really maximize my money. But for me, one of my financial goals is to have like just a really solid foundation, I suppose, like have a base of support, I suppose. So, have a car, have a house. And if you can have those 2 things and you have those paid off, then for the rest of your life, then that's just a really strong kind of personal financial platform. If you have your house paid off and if you've got a car, you can get yourself around and that's paid off, then, you really only need income for food, keeping yourself alive, leisure. And then any income, if you do end up being a high income earner, then I could use that money to try and, fund businesses and without too much fear of heavily investing or going all in on a particular project, just because I know that there's kind of like that fallback.
Yeah.
So for me, that they're my kind of personal motivations for wanting to buy into property. But I can definitely see myself in the long term owning multiple properties and trying to like actually have investment properties. But
definitely
once I think I have that house and the car, then I think I'll probably be more on the stock market side than property side. I know more about stock market investing anyway.
Yeah. I mean, I'd be the same. Certainly be nice to get a property to add some diversity, I think, in terms of types of assets. But I certainly know a lot more about the stock market than property. So that's
for sure.
where I'll be investing most of my money, I would say.
Yeah. All right, should we do this next one?
Yes, I'll read this one to you. All right, what's the best advice you can give someone, i.e. me, who is waiting for an exceptional company to be at an attractive and affordable price? Should I invest in a market tracker, some kind of ETF, bond, or wait some more?
It's kind of funny because the IE me is actually a part of this question, but it actually is us. It's like we are like kind of just waiting to buy good companies at affordable prices. What's the best advice you can give someone like me who's waiting for an exceptional company to come at an attractive price? Look, this sounds like a bit of a cop-out, but it's really not. The best advice is just to stay patient. I think that's one of the biggest things you can take away from listening to people like Warren Buffett or Charlie Munger or Phil Town in his books and the things he says on his channel is if you want to be really good at long-term investing, buying into great companies at affordable share prices, then, the money is made not when you buy, not when you sell, but when you wait. Who said that? Was that Charlie Munger? I think
Charlie Munger.
I
think you're right.
Charlie Munger. Yeah. Money is made when you wait for a long-term investor. So I know it's boring. It sucks. I mean, in the meantime, definitely try and look into some new companies, more companies, try and expand your circle of competence. And yes, you're right. If you want to be a passive investor as well, then you can still invest into obviously your ETFs, passive investing showing up every 6 months or 3 months or whatever and just keep buying. Yes, you can buy bonds, shorter term bonds if you just want to make a little bit of a return. But I think ultimately the best advice is just not to get that fear of missing out, just to chill out and stay patient and really stay on top of everything so that you are at all times, you've got your watch list and you're 100% ready to go. You know the price that you would be interested in buying at so that if it happens, because boy, share prices can move very, very quickly, as we've seen over the past year. If it happens, you're right there ready to go and you can take advantage.
Yeah, absolutely. Yeah, I think the only thing to really add to that, I think it's a really good answer, is, I mean, you can't, if you're waiting for stocks to get cheap, then you can't just put all of your cash into like an ETF because in all likelihood, or there's a very good chance that if that stock you're looking to buy goes down, so will the ETF. And then that kind of defeats the purpose of waiting for it to get cheap because you'll lose money on the ETF if you then have to sell it. So, if you're waiting for individual stocks to invest in, then you're going to have cash around. And hopefully you can get a little bit out of that cash. Maybe 1% is kind of the most you can get in Australia at the moment. I looked at term deposits the other day and it was like a 12-month term deposit at NAB was like 0.9%, which is just awful.
It's not good.
It's just terrible.
Real bad.
So you can get a little bit out of your cash, but if you're buying individual businesses, then you just have to have the patience to wait for opportunities to come and then spend as much time as possible looking at businesses. I think Peter Lynch says that, the best investors are the ones that turn the most stones over or whatever. If you're doing a lot of research, if you're looking at a lot of companies, you're more likely to find businesses that are great businesses and at a good price. But even then, I mean, I don't find many very often at all. I think I've found maybe about one per year since I started investing.
I don't think you really should be, unless you're in a deep, dark recession. You really shouldn't be finding a lot of businesses. I mean, remember Warren Buffett talks about the punch card with 20 punches? That's how a long-term investor should think about their investing career. 20 punches, that's all you've got. So, you'd want to make sure that you're absolutely certain or closely certain that, that's the right investment for you. I mean, if you're finding, 5 stocks a week that you want to buy, then your criteria probably isn't strict enough, I would say.
Yeah, exactly. Yeah, exactly right. All
right. Let's get into this last one, hey?
Yes.
All right. I'll ask it to you. Or did I ask you the last one?
No, I read the last one.
No. All right, I'll read this one. Hello, B&H. I think is B&H it's a company in the US, I think. It's like camera equipment or something like that.
Really?
Anyway, I don't know. Hello, Brandon and Hamish. I recently became interested in Vanguard's ESG funds, so like ethical funds.
Okay.
Other than a personal preference for socially responsible investing, are there any other compelling arguments for this strategy of investing? I'm all for index fund investing like a total market index or S&P 500, but I fear ethical screening can cause us to miss gains from companies that do well but are excluded from ESG funds. What's your take on the future outlook? Any comments would be greatly appreciated. Many thanks.
Yeah.
What's your thoughts on this?
I mean, okay. So first of all, I think that whatever you're investing in, I mean, whenever I'm looking at individual businesses, I'm always looking for businesses that have values that are aligned with mine. So at the very least, I can get behind the vision of where that company's going in the future, and what, what is their social responsibility, or more broadly, what's their responsibility to all of the stakeholders that are around that business, their employees, the environment, all of the other kind of stakeholders. So in that way, I think that you should always invest with your values. But I mean, any other compelling arguments? I mean, well, if you're looking at individual businesses, for example, then I would be thinking about, can they generate me enough money to make a high return? So it's not, it's not enough for me to just get behind the vision of a company. It still needs to make sense in terms of an investment, in terms of the return that I'm generating. But in terms of broad market ETFs, I kind of just stick towards the ones that are just total market indexes, like the S&P 500 or the ASX 500 or ASX 300. So I don't really go down the route of picking specific industries in terms of or specific types of I guess just unique like ETFs, that just have like a social responsibility attached to them or whatever. So I don't really have too much thought in regards to those, unfortunately.
Yeah. I think I tend to agree with you, because when I do my passive invest, like it's great if you want to be a passive investor or very close to that strict definition of passive investing, but you really don't want to hold, the gun manufacturers or the fossil fuel related companies, or tobacco or gambling, then like for sure you could buy an ethical ETF. And maybe, I'm not saying this will happen, but maybe that might outperform over time as, investors are getting more and more switched on to putting their money into more ethical investments. But I guess the point is, when it comes to passive investing, you don't know. The one thing that we do know, or the thing that gets tracked over years and years and years, is what the whole market does. And that's where we base our investing decisions off of. With the passive investing, is we look at the historical average of the whole stock market, say of the United States or of Australia, and then we invest over time to hopefully average ourselves out and assume that that long-standing average is likely going to continue into the future. So that you won't get exactly the general market return if you have an ethical kind of ETF. It might be close, it might outperform, but it also could underperform. But yeah, what you're saying before about the buying individual stocks, because I'm so focused on, for me and my investing, number one is that I have to be able to get behind the business. Like it has to sit with my values. That's like an absolute number one before I look at anything else. Like that is absolutely right. Like I would never invest in a gun manufacturer. I would never invest in a fossil fuel related company. I just wouldn't do it. I just wouldn't put my hard-earned money into one of these companies because it doesn't align with my values. So when I'm thinking more about like the ethical side of investing, I tend to focus much more on the active investing as opposed to the passive investing. So that's kind of how I go about my investing, I suppose.
Yeah, one other thing I just remembered that I want to talk about this is when you're looking at these kinds of different ETFs, just be careful about looking into how they select the stocks that go into that ETF, because for something like the Vanguard Australian Shares Index, that is just strictly the ASX 300, the biggest 300 companies in Australia. Whereas some of these, when you get into some of these unique ETF products, it might just be a selection of businesses. There might not be any, if one of the businesses in the ASX 300 does really poorly, it might move out of the ASX 300 and a new one comes in, and you're always getting the top 300. Whereas there might be a FANG ETF that just invests your money in those 5 tech companies, and they're not going to change at any time. It's the performance of those 5 companies. So that's just something else I just wanted to mention. Just be careful of how they're selecting these businesses.
They may not be tied to an underlying index.
Correct. Yeah, they might not be
like an ethical selection of an underlying index, I suppose.
Yeah, exactly.
No, that's a good point. But yeah, it's like everything. Make sure you read the kind of the fact sheets of any ETF product that you're thinking about buying.
Of course. Yeah. All right. Should we?
All right.
We can wrap it up there for today. Thanks everyone for tuning in. And as always, if you want to leave a question or a topic, as we mentioned, if you have a topic or a news story you want us to talk about, head over to the YouTube version of the podcast at youtube.com/The Young Investors Podcast. Just leave your question on the latest episode or your news story there as well. Thanks Sharesight for sponsoring this week's episode, and thanks Brandon for joining me as always.
All right.
And we will be back next week for episode 97. Getting really
97,
close.
We're getting close. Woohoo!
See you later, guys.
See ya.